Verge. Anything you want.
Gold on the verge of a major breakout that will cause price to spike, but the interesting thing is silver. Today, London whistleblower and metals trader Andrew Maguire told King World News that gold is on the verge of a major breakout that will cause the price to spike, but he said the interesting thing is silver. Eric King, NDREW, we are approaching some pretty important levels in the gold market. What do you see happening in the gold market, and where are the big bids underneath this market right now? Gold price set to spike. Andrew Maguire, Rick. On Friday, November 30th, we had the Bank for International Settlements option expiry. And if you remember, in our KWN interview approaching that, we said there was no way gold would be able to exceed that resistance level at $1,250 prior to November 30th. We've now hit that level, and of course the lid came off exactly on that day, November 30th. We started to see a rise in the price of gold, and right on cue we've started to approach a very, very important level. Andrew Maguire continues, obviously $1,250 is a round number, so it will have a lot of people's attention. But more importantly, $1,250 is a major inflection point. If we get a bit close above $1,250, watch out above, because I think we will start to see a big move. There are traders who simply trade that 50 level for a living. Either they short it when it arrives at it, or they go long it when it breaks above. If we get a bit close above it, these traders would revert to long. Then we will probably see a rise into the 1,300 Singapore dollars to 1,360 Singapore dollars or thereabouts before any kind of real significant pullback takes place. The real interesting thing is silver, but I think the real interesting thing here is that there is a massive gap close potential for silver. Is it time for the gold bulls to open the champagne? The gold market considered recent Powell remarks as dovish. And the market is always right, isn't it? Here's some insight by Rakadia Saran F. Unshine Profits. The gold market considered recent Powell remarks as dovish. And the market is always right, isn't it? Just below neutral on Wednesday, Powell delivered a speech, the Federal Reserve's framework for monitoring financial stability, at the Economic Club of New York. The majority of analysts judged the speech as dovish. Why? The key reason was Powell's view that interest rates were close to neutral. Interest rates are still low by historical standards, and they remain just below the broad range of estimates of the level that would be neutral for the economy, that is, neither speeding up nor slowing down growth. And indeed, it looks like an important change since last month, when Powell believed that the federal funds rate is far from neutral level. On October 3, in a question-and-answer session with Judy Woodruff of PBS, the Fed chair said, "Interest rates are still accommodative, but we're gradually moving to a place where they will be neutral. We may go past neutral, but we're a long way from neutral at this point, probably." However, the analysts omitted less dovish parts from Powell's speech. First of all, the Fed chair started his speech noting that the U.S. has almost fulfilled the goals of maximum employment and price stability. Congress assigned the Federal Reserve the job of promoting maximum employment and price stability. I am pleased to say that our economy is now close to both of those objectives. The unemployment rate is 3.7%, a 49-year low, and many other measures of labor market strength are at or near historic bests. Inflation is near our 2% target. The economy is growing at an annual rate of about 3%, well above most estimates of its longer-run trend. Let's make it clear, with the unemployment rate at a 49-year low, inflation rate above 2% target, and GDP growth above the potential, the federal funds rate at merely 2.2% is definitely not close to the neutral level. Just look at chart below, which paints the policy rate over time. Interest rates are ultra low by historical standards. And Powell knows that. He just wanted to calm investors after the recent stock market volatility. It suggests that the gains in gold might be temporary. Vulnerabilities at a moderate level. Moreover, Powell was optimistic about the risk balance of the U.S. economy. The major part of his speech was the discussion of the new financial stability report published earlier on Wednesday. Powell concluded that although he noted some growing risks to the U.S. economy, he did not see significant warning signals. My own assessment is that, while risks are above normal in some areas and below normal in others, overall financial stability vulnerabilities are at a moderate level. And we will see similar conclusions when we dig into the report. Although corporate debt is high, while asset valuations are elevated, the risks of destabilizing runs are far lower than in the past, while the key financial institutions are more resilient. It's not good news for gold. Implications for gold, as one can see in the chart below. The gold market agreed with the market analysts and judged Powell's speech as dovish. The price of the yellow metal jumped yesterday above the $1,200, which indicates that gold welcomed the Fed chair's remarks. However, the Fed does not see neither a broad-based buildup of abnormal leverage, nor dangerous excesses in the stock market. Therefore, it should continue its policy of gradual lightening. The next hike is still coming in December, and a few more next year. So, old bulls hold not open the champagne too early. But who knows? Today, the OMC will publish the minutes of its last meeting and we could learn more about the mindset of the Fed officials. Stay tuned. If you enjoyed the above analysis, we invite you to check out our other services. We provide detailed fundamental analyses of the gold market in our monthly market overview reports, and we provide daily gold and silver trading alerts with clear buy and sell signals. If you're not ready to subscribe yet and are not on our gold mailing list yet, we urge you to sign up. It's free, and if you don't like it, you can easily unsubscribe. Up today.